Welcome everyone to another episode of Financial 15. We're going back to our series or how to save tax in retirement. This is the 5th episode in the series. You can check out the other 4 on our YouTube page. And this one talking all about tax loss selling. What is it and how can it save you some money in retirement? You want to stick around.
Yes, as it seems, you can never have enough tips for how to save money in retirement. We always want to know those ones. But again, to find this, go to our YouTube channel. We really want you to take a look there. You can become a subscriber, figure out exactly everything that you need to find out for our videos. You can also go to our website at beckerorr.com where you can get access to all this stuff. Like us on Facebook. We are more than happy to deal with any of these titles that we can come up with and more savings for retirement for you as it goes forward. But today, as Clint mentioned, we are talking tax loss selling. What is it? What are the advantages? How does it apply to us in retirement?
Absolutely. And the first step, we have to understand the difference between capital gain and a capital loss. That's really the whole key feature of tax loss selling. He's using those capital losses to your advantage, using them strategically, so you can minimize your overall tax bill. Let's start. What is the capital gain? What is the capital loss? Capital gain, you can see it on the screen. There results from the sale of property. It could be stocks, it could be bonds, it could be real estate. Sale of property, the idea of capital gain, if you sell it for more than what you bought it for, sell it for more than the adjusted cost base, that's a capital gain. The opposite is a capital loss. You buy a stock for $10, you sell it for $8. Well, that's a $2 capital loss. And for the capital gain, Kevin, there's a 50% inclusion rate. So if you have a gain, you sell your rental property for, 50 grand more than what you paid for it. Half of that has to be included in your income and is fully taxable. So you don't pay the tax on the full bit, but you have to pay tax on 50%. That's the inclusion rate. And there are ways to help avoid that. And that's really what we're talking about today.
Yeah, I mean, definitely. When you're dealing with gains and losses, I mean, this is one of the better options to actually have. Interest, we know, is taxed fully. Dividends have a tax break to them, but are still more so. Capital gains basically give you a great tax break. But again, when we talk with gains and losses, we got to realize a few different things. All capital gains must be realized in the year that they happen. So if you sell a stock in 2021, whatever gain you would have on that has to be declared to the government. You have to pay your taxes then. Capital losses, again, can be used to offset the capital gains, except in the year of death or the immediately preceding year, because then we're adding a whole bunch of stuff into your income. But again, if you have $100 in gains, you have $100 in losses, they can counteract each other. And again, capital losses, unlike capital gains, do not have to be declared in the year it's going on. So if you have a whole bunch of losses this year and you don't want to realize your gains, you can go either 3 years back to use them against any gains you would have had, or you can carry them forward indefinitely until you have gains you can counteract them about. And again, the most important part to realize is that when we're talking gains and losses, we are dealing with non-registered money only. Anything that's in a registered account, as we mentioned, a TFSA, a LIRA, an RRSP, all these have specific tax treatments already. They are sheltered investments. So if you get a gain or a loss, you cannot realize them inside of a registered account. Only non-registered accounts does this apply to.
Absolutely. And again, we're talking stocks here, but it would also apply to property. So if you own a rental property, it could be a capital gain or capital loss when you sell the property. And then non-registered stocks also fit the bill. So TFSAs, RSPs, not really the issue here. If it comes to stocks, it'd be non-registered investments. We'll do a quick example. Say, again, a stock example. So you have a non-registered investment account. You buy $10 of XYZ stock. Later, you sell it for $15. Well, that's good. You bought it for $10, sold it for $15. You got a nice $5 gain there. If in the same tax year, so the same calendar year, you sell shares of ABC stock, but you originally bought that one for $25 and you end up selling it for $20. So you have a loss, a $5 loss. Well, in this example, you can use that capital loss to wipe away your capital gain. They completely offset, and there's no income to be claimed on your tax return. You avoid the tax. That's the whole concept there, Kevin, right there. If you can strategically trigger your losses to help offset some of your prior capital gains, you can avoid the tax bill. That's the whole game, right?
Yep, that's exactly what we want to have done. So, I mean, whether that's property related, whether that's stock related, whether that's bond related, any of these things can go forward so that you do get your loss to offset your gains if you have them. If you have no losses, that's wonderful. You still have to pay the tax, but we don't want it the opposite way if we can avoid it. We don't want just losses so that you can carry those forward forever. So again, remember, those are the things that you have to realize, that if you do have gains and you can find a loss, putting them together is really a good scenario to do in the same year so that you can get all this stuff looked at. And again, we did mention that losses can go back 3 years. So if you did pay gains, you can always use losses that you have in further years to offset some of those gains over the past 3 years if it's needed.
Yeah, it's a strategy. That's what they call tax loss
Yep.
selling. That's the whole strategy of tax loss selling. Tax strategy involving selling these unprofitable securities in the non-registered accounts, like we just talked about, and using it to offset the capital gains, like you said, either 3 years prior. You can carry that loss forward indefinitely. There is a special item we have to be aware of. We haven't talked about it yet, and that is a special rule, the superficial loss rule. We'll go through the details here, but you can't. The bottom line is, if you're down on a stock, say, "Oh, I bought my shares of XYZ bank company. I'm going to sell it today, realize my loss, and then I'll buy it back in a week." You can't do that.
No,
They're not going to let
at
you
all.
claim the loss if that's what you're trying to do. There are some special rules around that. I'll pull it up here. Kevin, why don't you walk us through the superficial loss rules?
Yeah, basically the superficial loss rules apply to the fact that the government does not want you to sort of realize the loss now, say it's done for the end of the year, and then, okay, well, the beginning of next year, which is a week away, I'm going to rebuy the shares because I think they're a great option. So that way I can realize my loss this year. I can either use it against gains and carry it forward, and then I'll get the stock back because I really like what's going on. If it's done within a 30-year calendar period, either before or after disposal of the security, you do not get to claim the loss. They have to prove by 30 calendar days that, look, you sold this because you wanted to take the loss going forward. It's not just a flip that we want to deal with. So you can't deal with it on the loss added to the ACV of the shares. And this applies to not only you, but also to a spouse or a common law partner, doesn't it?
It does. What they call an affiliated person. So it could be my account, could be my wife's account, could also be a company if I'm a controlling interest in that company or in a trust as well. So really anything you have control over, a company, a trust, yourself, your spouse, your common law partner, anyone in that kind of affiliated little network. If 30 days after you sell the security, if one of those are buying it, well, you're not going to get to use your capital loss. And in fact, that loss will be added to your ACB, and then it'll be part of a capital gain down the road. So essentially, if you sell the security, you have to sell it. You can't just sell it and buy it back through someone else or buy it back in your own account. It has to be a legitimate sale in order for you to capitalize on the loss and then use it against your capital gains and take advantage of tax loss selling. But one tip here, we're going to get into a couple of tips of how you can turn this into a strategy. One here, Kevin, you can buy similar securities. There's no rule against that.
Yeah, exactly. I mean, that's one of the big things. So, I mean, if you like bank shares and you have Royal Bank and all of a sudden you got a loss on it, there's nothing to say you can't sell it today and then go buy a TD Bank. I mean, it's the same sort of a scenario in the financial industry. That is not considered to be something you have to worry about the gain or the loss. You have two different securities. They are run different companies. So they may be similar fields. They may move in similar veins, but they are different securities. So you do not have to worry about that 30-day period. You can buy similar securities to do it. One point that we may want to mention, whether it's similar securities or not, that may apply to the last one, is that if you're moving securities from, say, a non-registered account to a registered one, TFSA or an RSP, you do have to realize the gain if it's there, but the government does not give you the loss if it's there. So, I mean, those are important points to also remember when moving things around. But similar securities are definitely one that we should look at. There's others that we want to deal with as well, though, aren't there, Clint?
Yeah, a couple of tips. That is the first one. You can certainly use similar securities. You claim your loss and then you buy something similar, so you still have exposure. And then the general concept, review your non-registered accounts regularly. Just look at the gains and losses. Often you can do this towards the end of the year. That's the most common time frame. And you can say, all right, is there a strategy here? What are my capital gains I've already realized? Again, not just stocks. Perhaps you own property or other assets that you've sold during the year, and then you can look to harvest some losses from your stock portfolio to offset the gains in those other areas. So reviewing in general your gains and losses regularly is part of the process. And that allows you to do the next tip, which is the strategic triggering of some of your capital gains.
Yeah, I mean, that's exactly it. When to time it, when to do it. And as you just mentioned, one of the most important points there is that the gain or the loss does not have to be from the same type of properties. Stocks don't have to match stocks. Bonds don't have to match bonds. Real estate doesn't have to match real estate. You can use the gain on one, be counteracted by the losses on another. So strategic triggering of these capital gains is really important because that way you can figure out when is best for you to claim it and things along those lines. That's part of the strategic capital gain scenario, isn't it?
It is. And there's a whole strategy there about harvesting tax losses. So if you sell a rental property and you say, oh, let's look at my investment portfolio. There's actually a few stocks that were down. Let's trigger those losses because we need the loss to offset a gain elsewhere. Then we can buy similar securities in the portfolio. So that way the portfolio still has exposure to the right areas. but we've harvested this tax loss. That's all part and parcel of what we're trying to do here. Give you a couple of tips on how to do that. And you probably already guess where this is going. You need to have a plan. You don't want to just wing it. It should all be part of a larger tax plan, which could be part of that larger financial plan. Really, to be organized and have a plan makes this a lot better.
Yeah, that's a big factor. I mean, there's a lot of people that I just want to hold the investment forever and ever and ever. And I mean, if you'd have bought Bell Canada shares or something along those lines, back in 1970, you probably have a substantial capital gain that you're sitting on that you've never, ever realized. That's great in one aspect, but when the tax man comes calling, there's going to be a very big bill to pay. So whether or not you hold on to a security a long time or you hold it a short time or get rid of the gains, making sure you have that sort of tax plan is really important. Knowing when you want, as you mentioned, strategic selling and buying of capital gains is important so that you don't have to have massive tax bills down the road or your estate doesn't have to deal with this sort of scenario. So the plan is very important, and knowing when to trigger gains and losses.
Oh, absolutely. You hit the nail on the head there. Maybe it's a legacy position if it's a stock one you've owned for decades, and now you're looking at estate planning. Well, someone's going to have to pay that tax bill. Maybe there's a way we could whittle it down over time. Sell a bit of a stock every year, try to find some losses to offset it. So that way you don't get a huge tax bill with the estate, and you've tried to minimize the overall tax penalty. So that's all part and parcel of tax loss selling, all part and parcel of having a larger tax plan. A lot to cover in a short time frame. So if you have questions on these topics or maybe a different topic we didn't touch on today, let us know. We're always happy to hear from you. Chatwithclintonandkevin.com. You can see it at the bottom of your screen. We always welcome your questions. Any parting comments, Kevin?
No, I think that covers it. Tax loss selling, another tax tip down for retirement. There's going to be more coming down the road. So stay tuned, subscribe to our YouTube channel, and you'll be fine going forward.
That sounds like a plan. Take care.